Most people think paying less tax means some complicated scheme, some offshore nonsense, or stuff that only the rich can do. It doesn't. After years of working as an accountant and tax advisor, here's what I've seen again and again. The biggest tax savings usually come from boring, simple decisions done consistently. Things that are available to almost everyone, but most people either ignore them or they don't understand. Here are some of the easiest ways limited company owners can legally pay less tax in the UK. First up, it's charging interest on your director's loan. Most business owners don't know this, but you can actually charge yourself interest to save tax and increase your director's loan, i.e. the amount of money your business owes you. Many business owners invest their own money into their businesses, whether it's to buy property, machinery, cover someone's wages, you name it. But what if you could make that money work for you? Let's say you personally invested for ease £100,000 into your business to buy a commercial property. Just like a bank, you can charge yourself interest on that loan at a fair market rate. If you were to charge yourself, let's say 6%, after year one, your director's loan would be worth £106,000. After year two, it would increase to over £112,000. After 10 years, it'd be worth more than £179,000. You see, just like that, you've increased your director's loan, i.e. the money that your business owes you, by £79,000. The extra £79,000 can be withdrawn from the company in the future, 100% tax-free at the time of withdrawal. Now, I know what you might be thinking, don't I need to pay tax on the savings income? Yes, you do, but here's why it is still so tax efficient. Firstly, the first £500 to £1,000 of interest each year is going to be completely tax-free, depending on your income, thanks to the savings allowance. Secondly, the income is exempt from national insurance, making it more efficient than a salary. And third, the interest that you're charging your company is then going to be a deductible expense for the company, reducing the corporation tax bill, so kind of counteracting the taxes that you're going to be charged. The net effect is it's one of the most tax efficient ways to pay yourself and one of the most overlooked. Second, let's go into holding companies. Once profits start stacking up, this becomes a big one. Most directors assume that if they want to invest into property, shares or other businesses, they have to take the money out personally first or set up large intercompany loans to SPVs. They don't. With a holding company structure, profits can usually be moved from your trading company up to a holding company without triggering any personal taxes at all. This means that you're not going to be charged 40% on your income tax or your 33.75% on your dividend tax. And it also means you don't need to create large loans between your companies, which can cause cash flow issues and increase risk, which a lot of people don't understand. Now, I won't go into all the details here because I've got a dedicated video on holding companies coming out on this channel in the next month or so. So make sure you're subscribed if you want to see that. Next up, it's reliefs that almost everyone qualifies for, but most people ignore or don't know they qualify for it. This is one of the most surprising things I see as an accountant, and it's how many people don't use the reliefs that they qualify for. Things like trivial benefits. You can pay yourself £300 in vouchers per year, completely tax-free. Staff parties. At Christmas time, for example, you could take yourself and your spouse as they're employed out for a meal at the local pub, £150 per head, completely tax-free. Your dividend allowance, £500 of it, tax-free. If you work from home, you can claim at least £312 back per year from the government, but maybe more if you use the apportionment method. There's plenty more that I could go through, and I appreciate that individually these don't sound exciting, but these stack up year after year. They really add up and they can save you a lot of money in tax. You see, good tax planning isn't one big move, it's just doing lots of boring ones consistently, and that's why you need a proactive accountant. Okay, next up is electric vehicles through your company. This is one of the clearest examples of the government just telling you exactly what they want you to do. Electric vehicles bought or leased through a company are one of the most tax efficient moves a business owner can make. If you buy or lease a new electric vehicle through your company, the entire cost is tax deductible, which frankly is pretty insane. That means corporation tax relief on the full cost, VAT recovery if you're VAT registered, and the personal tax charges are almost negligible compared to the amount you will be saving. Now, if you're already planning to change your car, doing this can literally save you thousands, and I mean thousands in tax. Okay, so now let's go on to pensions. I know they sound boring, but hear me out. The company pension contribution is one of the cleanest ways to move money out of your business. The key is the company should pay the contribution, not you personally. Because that'll mean, of course, no income tax, no national insurance tax, but it also means that you're going to get corporation tax relief when you make that contribution. It allows you to move your money from the company into long-term growth in one simple step. And yes, that money is locked away, but that's the point. It's money you don't need today, removed from the tax system and working for you for your future self. Used properly, pensions aren't restrictive, they're strategic. Now, the next point is about gifts and forward planning. For those of you looking to pass wealth on to the people closest to you, lifetime gifts can be incredibly powerful. If you're building wealth, unfortunately, inheritance tax becomes a question of when, not if. One of the easiest ways to deal with that is through gifting. Cash gifts can fall outside the estate entirely with no capital gains tax to worry about, as long as the gift doesn't affect the standard of living for the person gifting, and if you survive more than 7 years after making the gift. You can also gift personal items like jewelry or antiques, and these can also fall outside of inheritance tax, and you may be able to avoid capital gains tax if the increase in value falls within your annual allowance. There's nothing clever, again, it's just proactive planning instead of reactive planning. Then there's employing your spouse. This one is obvious, but it can be done quite badly at times, or even just not at all. If your spouse generally works in your business, you can employ them and pay them a commercial salary. What this does is this could potentially move you out of a higher tax band and push some of the earnings into the lower tax band, i.e. you'll pay 20% tax on your earnings rather than 40% tax on your earnings. You'll also be able to make use of their personal allowance to get £12,570 of that tax-free. You can do that twice, one for you, one for your spouse. And it's also, as a result, just going to reduce your overall household tax, or how much tax you pay as a collective unit. We typically see spouses being employed for admin support, marketing, social media, or operational roles within the business. So if you can do this in your business, I recommend you doing the same. Like I said, none of this is clever tax planning. There's no schemes, no loopholes. It's just understanding the rules and actually using them. Most people don't pay too much tax because they're doing something wrong. They pay too much tax because they're doing nothing, or they're missing certain easy tricks. If you're a limited company owner and you're not thinking about this stuff, you're almost certainly overpaying. Of course, if you have any question, you can reach out to me on Instagram, or you can book a call to speak to me directly via my website. Both of those things will be linked in the description below. If you did find this useful, I would really appreciate it if you press subscribe. I've got some more videos coming out like this to break stuff down in more detail without all the fluff. Perfect. I'll see you in the next video.